Hey, how's it going, everyone? Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about some of the things you can do to control your taxes. More specifically, I'm going to be talking about some of the things you can do before you retire that can have some control over the amount of taxes that you pay now. And then we're also going to be talking about some things you can do as you go into retirement. They're going to have some impact and some things you can control for taxes there. Now, it's very important to understand that these two things are going to be very closely related to one another. So things you may be doing today that maybe are intended to reduce your taxes today, right now, are going to maybe push you up into a higher tax bracket later. And it's very important to understand that relationship there. In fact, one of the things we've talked about in many other videos, probably one of the most important things to understand when it comes to tax planning is what is my income tax bracket today versus what is that income tax bracket maybe going to look like in the future. So that's what we're going to be talking about in today's video. But real quick though, before I get into the content of today's video, if you're interested in learning a little bit more about what we do at Money Evolution, you can check out some of the things we have over at moneyevolution.com. There you can learn about our comprehensive financial plan called the Money Evolution Plan, and also our retirement time machine, which is a DIY retirement planning program. So learn more about those. We'll also have some links down in the description below. Okay, so the first thing that I think we want to do here as we start to do any kind of a tax plan is really sort of give ourselves a little bit of a map. And this is something I've been really big about here as well. And when we're creating a map, the first thing that I think we should do is kind of put some of the big events on the map so we kind of understand what are some of the things that are going to be changing at different points in time. So for many of us, probably the most important thing may be when are we going to retire? Okay, so that's going to be a big one because we're going to go from maybe getting that regular paycheck, maybe hopefully it's a very high paycheck and we're in a high tax bracket, to a point where we're no longer going to be getting that paycheck and we may be relying on a pension or Social Security benefits or just taking withdrawals from our retirement account. Interesting to note as well, so you may, if you're married, have a different retirement date from your spouse. So you want to, basically as you're building out this timeline, you want to put maybe your retirement date, but maybe your spouse is going to retire a couple years early. So that'll be your spouse's retirement date. And you want to put that on the timeline as well. So you can kind of see when that income is likely going to change. Another very big one here, something that we really don't have any control of, is the change in the tax code. Now, we've talked about this in other videos. The Tax Cuts and Jobs Act rates, which went into effect in 2018, they are set to expire in 2025. So 2025 may be before you retire, maybe after you retire. Just to put it on here, we're going to say that's after you retire. So we'll say that's going to be the change in tax rates. And for those of you that aren't familiar with that, those tax rates that went into effect in 2018 had a sunset provision, meaning that they were set to expire at the end of 2025. So 2026, if no other new tax legislation gets passed by Congress, we're going to revert back to that old 2017 tax table, probably with some adjustments for inflation. But what that means is pretty much across the board, most people are going to see higher tax rates for every level of income that you may be at there. So that's going to be another very important consideration here. Another thing we want to put on here is required minimum distribution. So that's another one of those key things we don't really have a lot of control over. They just did make some changes to that at the beginning of 2023. And basically, depending on what year you were born, your RMD age is now either 73 or 75. If you were born 1960 or later, it's going to be 73. If you were born before that, then it's going to be age 73. And that's the age when the IRS has a mandated withdrawal plan for your retirement accounts, like your traditional 401ks and IRA accounts, where you're going to have to start taking some money out of those accounts, whether you want to or not. That's going to be something that's going to get added to your income. So you're going to have a few of these key milestones put on there. If there's anything else that you have, you want to put that on here as well. But understand a little bit about how your income taxes are going to change over time. So just like we talked about in many other videos that I've done here on the channel, probably the most important thing when it comes to all tax planning is really understanding what is my tax bracket today versus what do I think my tax bracket is going to be in the future. And all of these different things are going to have an impact on that. So obviously the day we retire and we go to that lower income maybe because we don't have the paycheck, that's going to be a change in our income tax. Also too, the required minimum distributions or when the tax rates sunset, those are all going to have some impacts. We want to really understand what that future tax rate is going to be. And basically, if we think our tax rate today is going to be lower than it is going to be in the future, then we want to basically do things that are going to increase our income today if it means that we can save income taxes later when we may be in a higher tax bracket down the road. On the other hand, if we are in a very high tax bracket today, we want to do things that are going to be there to reduce our taxes today because we're willing to pay taxes later at what hopefully will be a lower tax rate. One of the things this doesn't really take into consideration is the fact that all tax rates may go up in the future, and that's sort of my belief. I have an opinion about that, and I think a lot of people share that opinion, that with about $32 trillion of a national debt, not only are we going to see those current tax rates expire at the end of 2025, but I think down the road there's a very high probability, in my opinion, that we'll see higher tax rates across the board as we start to work out ways to pay for all of that debt and everything. So you want to really be looking at that. But I think also, too, a big myth that many people have is that their tax rate in the future will automatically be lower. And I don't think that's necessarily the case, both because of maybe those tax rates going up, but also because of how much money you may have in those traditional retirement accounts. So something very important to think about is if you have money in those traditional retirement accounts, what is that balance maybe going to grow to by the time you get to that RMD age? And is that going to push you up into a higher tax bracket with that one thing alone? Okay, so now let's talk about some of the things we can do that can have an impact on the taxes that we pay. So we'll start with if we're still working right now. Obviously, I think the big ones here are going to be the contributions you make to an employer-sponsored plan. So that would be like your 401k plan or any other retirement savings plan that you have through your employer. We basically have two choices. We can either put that money into a traditional account or a Roth account. So the traditional account generally is going to be where it's going to reduce your taxable income right now today. So if you contribute $25,000 to your 401k plan into a traditional retirement account, that's going to actually reduce your taxes by $25,000 or reduce the amount of your taxable income, I should say, by $25,000. And if your spouse does that, you can also use that to bring down the overall income between the two of you. So you may be able to lower your taxable income by maybe $50,000 or more, depending on what options you have there. If you choose the Roth option, that's going to be contributed on an after-tax basis, so you won't get any immediate tax benefit of it, but down the road, the Roth accounts are going to be tax-free as long as it's a qualified distribution. And there's going to be some rules on that, but basically you have to be 59 and a half, you have to have had the account established for at least 5 years and some other criteria there, but if it's a qualified distribution, it's going to be tax-free. So again, you want to really know what is the tax bracket today versus what is that tax bracket going to be in the future, but if we're trying to lower taxes, traditional, if we're trying to maybe push some income to today, it's going to be the Roth account that's going to be the way to do that. We also can do deferred comp in some cases. So if your employer allows for a deferred compensation plan, that can further reduce your taxable income by whatever you contribute to that. They may let you put up to another 10% or sometimes even more into a deferred comp plan. And then deferred comp generally are going to have a few more restrictions as to how that money comes out at retirement or upon separation of service there. You can maybe do it over a 5-year, 10-year, sometimes I think I've seen them as long as a 15-year payout. So if you are building up a very large deferred comp plan, that could really reduce your taxable income right now, but you also want to be planning ahead to the future to see, okay, if I can only take that out over a 5-year period and I've got $1 million in that account, well, that's going to be a lot of money coming out. So I may save some taxes today, but maybe those taxes down the road may be higher. So you want to really make sure that you understand what that deferred comp is. And also, too, if you're maybe going to separate service from a company, sometimes those deferred comp plans come out either all at once or maybe over that 5-year period, but you maybe aren't retired yet. You may be going from one company to another and all that deferred comp comes out and it's pushing you up into a higher tax bracket, even higher than you were if you would have just paid the taxes right off the bat. So sometimes deferring taxes isn't always the best way to go there, but deferred comp is going to be another one of those things. We're going to talk about Roth conversions basically on both sides of this, working and in retirement. But if you're really thinking that your tax bracket in the future is going to be higher, or you still have some room left in the tax bracket, you could be looking at doing some Roth conversions right now. And a Roth conversion is essentially taking money from a traditional retirement account and then paying taxes on that and moving it over to a Roth retirement account. So for a lot of people, and we've talked about this in other videos, that 24% tax bracket for 2023, I think goes up to about $369,000 of taxable income where you'd be in the 24% tax bracket. Now that's really substantially higher than what we think it's going to be when those tax rates revert back in 2026, probably by about $100,000. So if you still have room in that 24% tax bracket, it may make sense, even if you're still working, to do some Roth conversions up to that amount there. So that could be something that could push income onto today's tax bracket there. And really, I think what our goal here is, with almost any tax planning, we really want to look at creating sort of a level tax rate over time, kind of going from where you are right now all the way through the rest of your life, basically. And we don't want to have these big spikes and say, hey, we're going to keep our tax rate really low today, but that's going to be really high taxes later, or vice versa. Paying a lot of taxes right now so that we can be in an ultra low tax bracket later. We want to look at what makes the most sense that we can give ourselves a blended tax rate over time that's going to make sense for our situation. So one more thing we can do while we're still working that's going to have some impact on our taxes is going to be what we do with any money that we may be accumulating in what we call a non-retirement account. So that's going to be something outside of your 401k or your IRA accounts, basically like brokerage accounts or accounts you may even have at the bank or something like that. And that's going to be where you contribute money or you have money invested there, and maybe it's in some mutual funds, or maybe lately what's been popular is interest rates have been higher, so people have been buying CDs or money market accounts that are now paying a little bit higher rates. It's important to know how some of those different kinds of income are going to be taxed in that account. So things like interest income and short-term capital gains are going to be taxed at your ordinary income tax rate. And that's going to be always your highest marginal tax bracket. So if you're in the 24% tax bracket and you have any interest income or short-term capital gains, it's going to be taxed at that rate. Or if you get pushed up into a higher tax bracket, it might be higher than that. It might be 32% or even higher than that. So you want to be looking at how much of the money that you have in those non-retirement accounts is going to be thrown off as ordinary income. The preferred type of income here would be what's called a preference rate, and that's going to be things like dividend income and long-term capital gains. So long-term. And those are generally, for most people, probably going to be taxed at a 15% tax preference rate. If you're in one of the highest tax brackets, I think for married, finally joined, I think it's over about $550,000, you could get pushed up into the 20% tax bracket. And if your income is over $250,000, you could get hit with that net investment income tax, which would be another 3.8%. But it's still going to be less than what it would be as an ordinary income item there. So if you have mutual funds or you have investments, you want to be looking at things that you can hopefully focus on long-term capital gains so that you gain a little bit of control as to when those are sold, and you're not just getting statements every year at tax time saying you've got all these dividends and interest that you've got to pay taxes on. Okay, so now let's talk about some of the things we can do as we go into retirement. And I think for most people, once you go into retirement, you're generally going to have a lot more options for things you can do that can control your income there. So if you're retired, so one of the things you can do right off the bat is you can decide when to take your Social Security benefits. That's something that gives you a little bit bigger window if you're trying to do some Roth conversions, or you just want to push some income out into the future. But for a lot of people, it does make sense to delay taking their Social Security benefits to at least your full retirement age, which for most people is going to be age 67, but you can take it as early as 62. 67 is that full retirement age for most people, but you can delay it and get delayed retirement credits up to age 70. So it may just make sense to delay Social Security just because of the higher amounts that you could receive, but by keeping that income lower for a few more years, again, may give you some opportunities if you're trying to do some Roth conversions and say, hey, I've got too much money in these traditional retirement accounts and I need to get that money over to a Roth before I get hit with those required minimum distributions at 73 or 75 or whatever that may be. So Social Security is going to be one of those things. Pension is going to be another one. And there's definitely some different pension options that most people are going to have. If you're married, you're going to definitely, I think, want to consider doing some type of a survivor benefit for your pension, meaning that your spouse will get at least part of your pension benefits if something should happen to you. That's a whole other conversation there. But one of the other big choices that many people have is the option for a lump sum. And that's something that, depending on all the other factors that are going into your retirement, might give you some additional control. So if you get that regular pension, it's just going to be the same amount every year, and you're going to have to kind of work around that for basically all of your tax planning. But if you get a lump sum, now you can control how that kind of gets paid out, essentially, and maybe you could even take some of the lump sum and be doing some Roth conversions with some of that. Again, there's a lot of other factors that go into that, but the lump sum is one of those things that could give you some additional options there. The other thing we talked about earlier with the working is, again, if you did any kind of a deferred comp, that's going to be another thing you're going to want to make sure that you have planned, and you know that, okay, I've got $50,000 a year coming out for the next 5 years, that's going to be taxable income, and there's not much we can do about that. That's just going to be coming out, and we're going to have to build our tax strategy kind of around whatever that deferred comp is there. So those are some of the things that you can be looking at there, and again, keeping in mind all those different moving pieces, and sometimes they can get kind of confusing and sometimes overwhelming, because we're talking about a lot of different things, and as you're probably noticing, when we change one thing, it often has impacts on something else. And so really having a plan or a system to kind of bring it all together, I think, is really what makes sense. So of course, our comprehensive financial plan does that. I think it does a fantastic job of bringing this together, kind of building out sort of a digital timeline so you can see all these different moving pieces. Inside the software that we use, there's some really great forecasting, so we can see what the potential income tax rates are going to be at various stages in your life as you go into retirement and things like that. And then we can very easily kind of make some different scenarios and say, if we did this, if we did some Roth conversions, or if we did a deferred comp, and then kind of see very quickly what some of the impact is going to be on a number of those different areas. So anyway, I hope this video made sense. Just looking at some of the different things that you can do that can have some control or some impact on the taxes that you're paying right now. And again, a lot of times when you move something over here, it's going to have an impact over there. So it's we got to be more than just focused on what our tax rates are today, but looking at how those tax rates are going to kind of flow throughout time. So anyway, I hope you enjoyed today's video. Remember, always hit that like or subscribe button there, and I look forward to seeing you back in one of our next videos. Thanks.